right, welcome to the Baldwin CPA's webcast, an update to the PPP Loan Forgiveness Application and process. On Friday, May 15th, the Small Business Administration, in conjunction with the Department of Treasury, released the PPP Loan Forgiveness Application with detailed instructions. These new guidelines require PPP borrowers to complete and submit an application in order to have part or all of the loan forgiven. During this webinar, we will walk you through the PPP Loan Forgiveness Application, the required calculations, and best practices to maximize the opportunity to have your Paycheck Protection Loan forgiven. Our presenters today are Baldwin member Lisa Foley, CPA, CGMA, and accountant Matthew McKirahan. And at this time, I will turn it over to them.
Thank you, Leslie. It's been a couple weeks since we've been here, so I'm glad to be back and glad to have some information to share with everyone. What I will say is, as Leslie alluded to, is we got the application for forgiveness and the instructions. We still don't have final guidance, and since this past Friday night, about 7 o'clock, they passed this out. There's already been great debate of the instructions to the application. So I'm sure that will continue. Just know that we will keep you informed. I don't know in a 2-month period I've ever said the word fluid as much as I have, but that's the situation we're in. As most of you that have been living in the PPP program understand, you make decisions based on certain facts and then that gets changed, and that is continuing to happen. So I do think we got some really good, more concise, clear guidance, but there are still definitely some question areas, and we will keep you updated on those, and just wanted to share what we know at this point, and we'll continue to help everyone get through this. So with that, we'll get started. One other thing I wanted to touch on today, so the instructions and the application were released Friday night on the 15th, but there was also a very important FAQ number 46 that was issued 2 days prior on the 13th that I wanted to talk with everyone about, because I know we've had a lot of questions about this in our past webinars, so just wanted to alleviate some concerns here. There was a lot of media surrounding Shake Shack and Ruth Chris getting the money and ultimately giving it back, even though they met the rules that were in the PPP program. So the Treasury did release some guidance on that, because after that happened in the scrutiny and the fact that those who receive PPP money will be public record, people got concerned, should I really have applied for this? And when the application for the loan program came out, the only thing you had to certify that you believe there was current economic uncertainty that makes the loan request necessary to support your operation. So everybody that signed a PPP application for the loans attested to that. So what they did was they came back with FAQ 46 way after the fact and created a safe harbor, and basically said that, any borrower and your amount of your loan is less than $2 million will have been deemed to have made that certification in good faith. Basically, they're really not going to test what your uncertainties are, whereas if you're over that $2 million factor, you really are going to have to document, loss of clients, change of revenue, loss of staffing, contracts being pulled, deferred. You're really going to have to make a really good documentation case for why you applied. And the reason the SBA came out with this is they really felt like people that were in the $2 million category and under, or under 2 million, they're less likely to have access to sources of liquidity. And I think, in hindsight, they really should have just come out and said, for sure, public companies can't do this, but they didn't say that. and there was a lot of fallout. So this was their fix on that. We definitely still, so even though this is a safe harbor they've thrown out there, we still recommend that you internally document this because it still could come up. I know I talked with several clients where the bank was actually making them sign off on some additional documentation to this fact. So I just think it's just makes good business sense to document the decisions you made at the time you applied and why it was uncertain at that time, because that's when you made the certification. So we just wanted to remind you about that. Really, I think alleviate a lot of concerns that everybody had because this has been in the press. So if you're in that under $2 million loan amount, that burden has been lifted, but we really recommend you still document internally why you made the decision you made. And if you need any help with that, just please reach out to us. We'll be happy. We've talked to lots of clients and have lots of feedback and are hearing new reasons every day of why this is important and helps their business. So just wanted to touch on that outside of the application. And because there was also a caveat, if you felt like you couldn't meet these things, you had to pay the money back, and that time I believe has passed. But just wanted to touch on that they did give you a safe harbor if you're under that amount. Still document it, but you should be good to go in that because that's been an area of concern. So what I'm going to move into next is some of the things that were clarified for us through the instructions that came with the application. And then later on, Matt's going to walk us through the application and some examples of some of the calculations. I know a lot of people that are participating today had access to our spreadsheet. The spreadsheet's definitely going to change based on the guidance. So look for that, and we'll be sharing that later this week as we get it tweaked. But the things that are in here, they really have made some safe harbors and some changes to verbiage that should make attaining the forgiveness part a little bit easier, quite a bit easier actually. And one of those things that we've talked about is the 8-week period. So as we talked about in previous webinars, your covered period is the 8 weeks that starts on the date of your loan disbursement. And you notice that says the date of the first loan disbursement, because recently in the last week, they did come out and say that if you were a partnership and you filed your application under information that wasn't available, that basically didn't allow you to put partners on there as a payroll item, that you could redo that. So we've helped several clients redo that if you are in that partnership format and you didn't include the income of partners in there. So even though you filed, that application may have been filed last week, the forgiveness calculations still go back to the first date that you got the first disbursement. So some people have got 2 disbursements, but your 8-week period starts with that first disbursement. So what they did come along and say is that, there was a lot of people putting off their first payroll and trying to get the money in their account, so that you're kind of playing with that covered period to make sure you cover a full 8 weeks. So what they did come along and say is that you can actually change your covered period for payroll. If you have a bi-weekly or more frequent payroll, you can elect to start your 8-week period on the first day of the first pay period following their PPP loan. So that gives some flexibility that should help us all not have to, if you're a bi-weekly, I know we've given guidance in the last webinars about accelerating your last payroll to get that in there. So with the ability to do this, and you really don't decide this until you do the application, we can help you look at it both ways to see if one way is more beneficial than another. But it's going to give us the ability not to have to play with those payroll dates, is basically what that's going to do. So the next item that was very important that we've talked a lot about over the last few webinars is incurred versus paid. and they've came back and made that very clear for payroll costs and non-payroll costs. So I've fielded the first bullet point there many times over the last 4 weeks. And we had told everybody we believe that your paycheck date is the date that you go by. And that is correct. Or a lot of people utilize a third-party payroll provider. So if that ACH is generated, a couple of days early before the pay date, you can use that. You can use one or the other. So they did clear that up. And so that's for the paid side. If you want to go the incurred route, they're going to tell you that incurred means that it's the day the employee's pay is earned. So it's this or that you'll see we've got highlighted and bolded and underlined on here. It's very important because they're giving you that choice. Because in the past it said incurred and paid. So they have changed that verbiage to incurred or paid. So that's going to make this a lot easier and you won't have to move around and jockey payroll dates and different things. So you can do the paid, and you could accrue the days. So if you get your payroll, the last payroll is going to straddle the end of your 8-week period, you can accrue the time that was actually earned and include that in your payroll cost. So that's what the last point. And then the other thing on the non-payroll cost, again, they changed that to paid during the covered period or incurred during the covered period. So, and if you don't pay it in the 8-week period, as long as you pay it before the next regular billing of that particular invoice. So for instance, a utility, let's say it covers your 8-week period, but you don't pay it until after the 8-week period date, you can still count that as long as you pay it before that next billing cycle. So those are very advantageous changes for loan applicants. So I just wanted to definitely point that out. That's what the instructions definitely clarified in that regard. So a very helpful change. So the next thing, we got some further clarification that we've talked about on non-payroll costs. One of the big ones in the first area there that we've talked about is payment of interest. And basically all guidance we had to this point said, business mortgage interest. But the instructions clearly say that you should be able to do this on real or personal property. So if you have some loans that are secured by equipment and secured by vehicles, the way this reads, unless we get further clarification in final guidance, I think you're good to go in deducting that interest. So that should really help people be able to obtain spending more of these non-payroll costs and getting that amount up. One thing to note, which they had said all along, is those loans had to be in place on February 15th. So if you bought a new piece of equipment since February 15th, make sure you don't count that, but anything that was in place before 2/15, you can count the interest on that. So rent, again, same concept. It's paid or incurred, and again, that lease had to be in place by 2/15. So there. And then the last item that there was a great debate over what this all included. The instructions specifically say now electric, gas, water, transportation, telephone, and internet. So telephone and internet were two we were very, very unsure about, but they have clarified that your phone bills and internet bills do count. So that's going to be a great help. And then transportation, we don't have that defined anywhere, but have spent some time with clients and on other webinars, and really everything we see points to fuel being a deductible expense, which is going to be a real big game changer for those in the construction or delivery business for sure. But all things point to fuel being a allowed expense. So stay tuned and we'll keep you abreast of that. But that really should be give you a lot of room to help your non-payroll cost get that number up and help with your forgiveness. All right, the next item I wanted to talk about was they changed the definition of FTE. FTE in the past with the SBA has always been calculated at 30 hours per week, but now the application instructions are out, it does say 40. So that is definitely going to change. I don't know that that's going to be a huge problem for everybody that's been calculating based on the 30, because you're also changing the calculation back to the comparison periods. So you should be comparing apples to apples unless something has really changed in your business. So I don't think it's going to cause you an FTE problem. And there's some more safe harbors in the FTE as we move along today that can probably help you as well. But they do have a great simplified method to make this a little bit easier. So anybody that works 40 or more count as 1. And then anybody that works under 40 becomes a 0.5. So, you know, especially if you have a lot of people that are working 20 hours or less, this 0.5 is a little bit, they've thrown a little bit of a bone to you to let you just say, hey, simplified method, they count as 0.5. If you've got more people in that 20 and above, it may benefit you to do the detailed calculation to come up with more than 0.5 for each person to help your FTE number. So really they tried to simplify that, make the burden a little bit easier. So just wanted to share that today. And like I said, our spreadsheet had given you guidance on 30, so we're definitely going to be updating that to help. The comparison periods back for your FTE, that still remains the same. So you're still comparing to the time frame of February 15th through June 30th of 19, or January 20 of 20 to the end of February. So you can still pick the lesser of those that helps your ratio, but that part hasn't changed. But the 40 hours per week is the definition of their FTE on the application, as well as the simplified version of calculating that. All right, so next screen, I just wanted to tell you a little bit about the application, and then Matt's going to walk us through some things on that. So what they gave us was they gave us the actual loan forgiveness calculation form. They gave us a Schedule A, which is where we're going to calculate the FTE and the 25% reduction type items. And there's even a more detailed worksheet that feeds into some of that. And then they also include in the application that there's a borrower demographic information form that is optional. So my guess as we dive into the application and all the work we're all going to have to do to provide this to our lender, number 4 is probably not going to happen too often, because I think there's enough work in 1 through 3 that we're all going to be done with forms at that point. But 1 and 2 are the only items that get turned into the lender servicing the loan. 3 and 4 do not get turned in. So that kind of gives you an overview. And then I think Matt's got some great screenshots of the application if you haven't seen it, and I will turn it over to him to walk through some of that.
Thank you, Lisa. Appreciate everybody being on the call this morning. I thought I'd give a little bit of humor here starting out when we start thinking about this application. I love going to the back. So it's actually 11 pages in total, this loan application. And on the very back, at the very bottom of the 11th page, it talks a little bit about the time frame, how much time it will take to do this application. And so we've already obviously started working on our spreadsheet for you all, trying to get these detailed calculations set up. That way they're accurate and precise. And so even on the back of this application, it says the estimated time for completing this application, including gathering data needed, is approximately 180 minutes. So just from that, that's usually, they're underestimating that time. And so they're usually goal-oriented and think we can do this very quickly. And so this is just going to have to be a time-consuming thing that we help you all, or you all, when you work on it, just got to be very diligent with paperwork and gathering data and on completing this application. So on the front end, I thought that was kind of funny that they went ahead and actually gave us a time limit of how far and how long they think it will take us to complete this application. So with that being said, we'll move into the first screenshot of the forgiveness application. And so the reason I wanted to go ahead and put this little screenshot on here is obviously you can see that this is the PPP loan forgiveness calculation form. This is the top half of the first page. This is where a lot of your administrative information will be going. You can see obviously your loan numbers will be there. And so making sure we have those loan documents available to fill out this information. Employees at time of loan of application is important as well. Those were on the front end. We had actually, if we were involved in helping with that, that was what we were actually putting on the initial application. That is actually not used in the forgiveness application, but in employees at time of loan application, I believe is just going to be a FTE number at the end of your 8 weeks at the time of when you're submitting this application. And so you got your EDIDL loan advance on here. If we've actually included that into our PPP loan, I'm going to ask you to go ahead and the frequency of which payroll is paid to employees, wants us to mark that, and then we're actually going to come along and do our covered period. And then if we want to, if we need to, go ahead and use that alternative payroll covered period that Lisa mentioned that I do believe will be very beneficial. And then if you are in excess of $2 million, you would check that box as the SBA said they were going to review all loans over that amount. So just top half of the first page, just kind of wanted to show you where this is a lot of the administrative stuff will be. This part will not be included in our actual spreadsheet we send out. Obviously, they have a fillable form for this, but I wanted to give you half of that because the other half is where you actually start looking at your forgiveness amounts in the calculations. And so this all will be as put into our spreadsheet to help you populate these numbers to be able to fill out this fillable SBA form. And so our spreadsheet will be geared towards mirroring the actual application itself, and then with obviously the calculations pulling from one tab to the other. So just kind of a heads up of that's what's coming. But wanted to go ahead and show you a little bit of how they're actually going to be calculating your forgiveness amount, because once we get to the bottom, there are actually 11 lines. You can only see 7 here. You'll see the next 4 on the next slide here, but I wanted to talk about the first 7 here. So none of these have really changed from our spreadsheet that we had initially. Line 1, you're looking at payroll costs. That definition is the same. So that definition we talked about on applying at the forefront for our actual loan amount, that definition is still the same. So that would include obviously wages, any compensation, including tips. That also includes health insurance, that stuff. All that definition has stayed the same. So you would put that amount in there. Line 2, obviously you got your mortgage interest that we now have some clarification on. But line 3, you got your rent and lease payments. And in line 4, your utility payments that we now have clarifications on. So I wanted to kind of follow example 1, and do forgive me, we couldn't put all this on one slide, so I am going to go back and forth, but wanted to kind of walk you through example 1 to show you what it would look like for your loan forgiveness amount, and then walk you through example 2, because the way they're going to be calculating your 75-25 rule that we talked about is a little different, and I kind of wanted to explain that. So example 1 here, you have payroll costs. So that's all that health insurance, group health insurance, wages, came out to about $400,000. $50,000 for mortgage interest, $25,000 for rent, and $25,000 for utilities, a total there of $500,000. Line 5 is where we would get to a deeper calculation, and we will talk about that. For this purpose of example, there was a wage reduction of $50,000. That is just an example, and we'll actually look at that calculation here in a little bit. But there's a $50,000 reduction, and so then you would come down to line 6, and so our total eligible forgivable expenses is limited to $450,000. Then you'll have to look at your FTEs. And so in this line here, in this example, there was no reduction in our FTEs. And so that'll be what they're calling a reduction quotient, and that'll actually be calculated on the application. And for this purpose, you want it to be at 1. That way there would be no reduction, and we actually don't have to multiply out that reduction quotient. So I am going to jump to the next slide here. So just remember that our loan forgivable expenses is $450,000, and then our also payroll costs were $400,000, because that's going to be important for lines 8 through 11. So we have a modified total, which is all those forgivable expenses. Then you have your loan PPP amount, and for this example was $475,000. And this is where it gets a little bit tricky when you're calculating your 75-25 rule, because they come along and said, now we're going to divide line 1 by 0.75. And so line 1, I'm going to back up real quick, was the 400,000 of payroll costs. So we're still looking that 75% of it has to be on payroll. They're just going about calculating it a different way. So you would take that 400,000, divide by 0.75 to get an amount of 533,000. And then out of these three, line 11, you're actually going to get your loan forgiveness amount. And it's the smallest of lines 8, 9, and 10. So in this scenario, it would be our actual forgivable expenses less our reductions would have been 450,000. Now, I wanted to show an example too of where it can be a little bit tricky and change. And you can see your non-payroll costs will get limited based off of what our payroll looks like. So let's go to example 2 real quick. 300,000 for payroll, 100,000 for mortgage interest, 75,000 for rent, and business utility payments, 25,000. All add up to the same $500,000 example. We still have the same $50,000 reduction. So total amount 450,000 after the salary and wage reduction. Quotient reduction for FTEs is still 1. Come down here, you got your modified total of 450,000, your loan amount of 475, and your payroll costs. That calculation again that we talked about would be 533. And so in this example, we are limited to our payroll costs of the 400,000. I do believe I do see a typo, so I do apologize for that. So example 2, you would be limited to your payroll costs, and that calculation will work out. And so I really wanted to talk also about the salary and hourly wage reduction, because obviously that 50,000 number example on the front is a big number, but I wanted to make sure we talk about this because this has changed a little bit in terms of the definition and how we're kind of covering it. Whereas first around, the initial guidance that we got from the CARES Act really wanted us to look at total compensation paid during different periods, whereas now we're looking more at rates. And so I'll preface this with, this is kind of the sticking point that when this came out Friday night, a lot of people have been debating and thinking about, well, what's the definition of what's in A and B? This whole concept of average annual salary or hourly wage. And so it is actively being talked about and reviewed. And there have been, to be honest with you, it's probably like a 50-50 split where we either go look at costs still or rates. And so I kind of wanted to give you an example of rates because I do believe this is what is more beneficial for our clients in helping with the forgiveness. And so I do believe that this will eventually be the final verbiage. A lot of people have gone this way as well, but just wanted to make sure that this could be subject to change moving forward. So step 1, obviously we're going to determine if pay was reduced more than 25%. So in line A there, you're going to enter average annual salary or hourly wage during covered period or alternate payroll covered period, what Lisa talked about earlier. So hourly wage, example 1, you have, say an employee was making $10 per hour during our covered period. We would mark $10 per hour in there. Line B, you'd come along and we're gonna go back and look at the first quarter, just like we were told to in the previous guidance, except we're not pulling amounts. So we kind of alleviated that whole 8-week versus 13-week comparison. And so we would go back and look at their hourly rate in that time period. And in that case, in this example, it would be $15. And so you can see based off that, we would divide the value entered in 1A by 1B, and we'd get 66.67%. And so if 1C is 75% or more, we don't have a reduction. And that's kind of where they got to that 25% reduction amount in the first round of guidance. So if it's 75% or more, we enter a 0 in a box that is also in the application that we'll talk about. Otherwise, we would proceed to step 2. And so I kind of stopped here because this is actually a very important point, this first step here, which I think will alleviate a lot of us from having to go forward and do any more calculation. So very simplified. It works out great for the clients. And so, but if we have done reductions, just know there are some very, very detailed calculations that come after is in steps 2 and 3. There's a lot of weighted averages in the mix. And so we're working on putting that together in a spreadsheet to help you all. Just know that those complications and corrections, once we get past step 1, are going to be very complicated. But let's look at hourly wage.
I would just mention again, you know, the most important point here is they are letting you compare an annualized amount to an annualized amount based on 2 different periods. So the 8 week comparing back to a 13 is gone. So I feel like, and I think Matt agrees, the chance of somebody hitting below that 75% is going to be a lot less than it was the way it originally came out. So I'm hoping this is going to keep most people from having to move on and do the detailed calculations is kind of how we see it. Because even if guidance comes out that changes it, you're not looking at someone's individual rate of pay from an hourly standpoint. You know, our experience has been that most of our, if you are going to look at the rate, most of our clients have paid people a little bit more to be able to come to work and be kind of in a hazard situation. We've not seen a whole lot of hourly rates going down. We've seen some salaries reduced in a cost-cutting mechanism of, you know, maybe people are cutting salaries 20%, but even if you've done that, you should still fall in this 75% rule that you're not going to have a problem and create a reduction. So I think they have definitely simplified this. And I know one of the things Matt and I have talked at length about is basically you still got to spend the money, and we'll get to that. But so you're penalized if you don't spend the money. But we also talked about it seemed like how we were getting double penalized if you didn't meet FTEs and you didn't meet the 25 reduction. It was just keep on snowballing the amount coming from it. And I think they've tried to, the intent is they've really tried to alleviate this 25% reduction hitting very many people.
Agreed completely. And we'll kind of see that going forward. Whereas I think it's really great to know, and a great point you made there, Lisa, if you haven't changed rates, but we've done something with hours on the front end, when the initial CARES Act came out, you were getting penalized in both areas based on the reduction in compensation and then also the reduction in hours because of your FTE calculations. Whereas now in that scenario, you're really only going to be looking at your FTEs based on your hours because the rate hasn't changed. So they've really come along and simplified that, which I think is great for clients.
And just to be clear, the point of contention, like Matt said, is for hourly people, it's just not very clear whether you look at their rate or you have to annualize their payout by their hours. And it's 50-50. Guidance is being given both ways. So that's just something that's going to have further guidance. But I do think they've definitely cleaned this up for us in the most part, and hopefully will alleviate most people from having to do this calculation.
So let's look a little bit out here. You can kind of see hourly wage example 2. If you haven't changed rates, you're at 100%. I mean, you're going to move on. You're going to enter a 0 in actually the table that they're having us fill out in the application for this column, and we would move on. Salary wage example 1, we have reduced salary to $35,000 from $56,000, and so we would have to move on to step 2 because we are below that 75% threshold. And then obviously the example there, the $56,000 is 100%, and we would not have to worry about that either. So moving on to a little bit, talk about some FTE reductions. Obviously, we know those calculations are very consistent and have stayed the same from the initial wave of guidance that we got on the CARES Act versus the application. There are some exceptions that I kind of wanted to mention here. So exceptions to the FTE reduction exist if the following situations occur during the covered period. So this is where I know I fielded a lot of questions in regards to what happens if employees leave voluntarily. Well, that is actually one example of we would not have to exclude, we would basically exclude them from our FTE calculation because of them leaving voluntarily. So other example is offers for rehires in writing that are subsequently declined by the employee would not be included. Employees who were fired for cause and documented that would not be included. And then employees who request a reduction in hours and wages due to obviously employer not having to reduce those, that's being asked by the employee, we would not be discredited for that as well. So I wanted to make sure we mentioned those FTE reduction exceptions. I wanted to spend a little bit of time here on the safe harbors because I think it's good to note, and I think these are very beneficial and advantageous. And so the salary and hourly wage reduction safe harbor, you're basically going to be looking at your annual salary or hourly wage and making sure it's restored by June 30th, 2020. If that's done, then we don't have a reduction. There's a box in the application that we would check, and then we don't have to worry about going through and doing those tedious calculations. I think that's important to note, because if we can make sure, I mean, it's very 30,000 foot view, but if we can restore wages based off of that June 30, 2020 date, it's going to alleviate a lot that we would have to do for this application. The FTE reduction safe harbor, you're going to compare your FTE employee levels at June 30th, 2020 and compare to February 15th, 2020. If it's the same, they're in and there's no reduction. So same amount, there's no reduction. I also wanted to note one little thing about when looking at the application, there is a line 10 on Schedule A, that allows us to look at FTEs on December 31st. And so it's still being kind of debated, and the wording there is being scrutinized. But from what it reads, it basically allows us to look at our FTEs on December 31st and compare to the end of our 8-week period. If those two numbers are the same and have not changed, then we would also be excluded. So they've kind of got like a little bit of a 1A and a 1B for your FTE reduction safe harbor there. So once again, very advantageous safe harbors that have come out with the application that I do believe will benefit individuals filling this out.
And Matt, just what we want to mention there for sure is, you know, it appears we've been given a gift of getting out of the wage reduction and also the FTE quotient if you're back to where you were as of June 30th. But the problem is you still have to spend the money. That's where it's going to catch people. So people that haven't been able to open, if you haven't spent the money on payroll, you're not going to have as much to forgive. So it's almost like they're throwing these two little reductions out for you, but still, if you didn't spend the money in your 8-week period, forgiveness is still going to be a challenge unless we get different guidance.
Yeah. And so I'll stop here a little bit. And so just making sure these are the major points that are in the forgiveness application. It is 11 pages in length. The Schedule A, like I said, be looking for that in our spreadsheet that is going to be coming out. The goal is to any calculation number that is on the application would be put into our spreadsheet so that it would self-populate based off of input numbers. So just kind of giving you a heads up, we would input numbers, things such as hours, rates, things of that nature to help with those calculations, to then be able to pre-populate what they're calling Table 1 and Table 2 in the application. Table 2 is for anyone over that $100,000 cap that we talked about in an annualized salary or hourly wage. If you're over $100,000, they would be in Table 2. And then Table 1 is looking at the bucket of employees that are under $100,000 that we have to kind of go and calculate that reduction in wages and the FTEs for. So both those tables will be pre-populated into our spreadsheet, which would then be able to be moved to each other tab, which is the Schedule A and the Schedule A worksheet, to be able to help you calculate what your actual loan forgiveness amount would be. So that being said, it's 11 pages in length. It's going to take us about 180 minutes compared, is what they're telling us that it will take. Obviously, I believe it'll take some more on the front end. We will do our best to help with the application and what the spreadsheet might look like. But there are some things still unanswered. And so the next slide here, and I know Lisa and I can both kind of chime in here, but there's still some guidance needed. So Lisa, do you want to kind of jump back in here and talk a little bit?
You know what, the question I think we're fielding every week, if not every day, is Kentucky especially is, you know, we were very, you know, when it was a double-edged sword because, you know, the PPP loan funds, that first wave went very quickly. So everybody was, you know, afraid if I don't apply, I may be out of luck. Well, you know, because we can't trust that the government was going to come back and make the second funding, and there still seems to be a bountiful amount of money still out there. So people can be applying now up until June 30th. The problem is a lot of people applied in the first wave. So now they're 5-6 weeks into their 8-week period, and our government won't let certain businesses open, retail, hair salons and nail salons and barbershops and, you know, restaurants. So, I mean, you know, they've been in a rock and a hard place. So just know that if you're in that group, you know, really there is no relief right now. Yes, you can choose the alternate pay period, which might push you 2 weeks down, since it for a biweekly person. But right now there is no relief. And just please know that the AICPA is lobbying very hard on the CPA profession's behalf for our clients to get some relief here, because if you cannot open your business, there is no way you can spend this money on payroll unless you're paying people to not work. And my experience has been from talking to my clients that they're just not going to do that. They just, that doesn't feel right. If they bring them back and pay them, that's not happening. So I know in the restaurant industry that's not happened. And I know in hair salons that I've not seen that happening. So we really still look and hope the AICPA can lobby hard enough to bring that ability to move the 8-week period if you were under state orders. But at this date, we still don't have any clarification on that. So we just wanted to mention that. And then the other thing is, all along, all guidance up to this point has said that your loan forgiveness amount will be the loan plus any deferred interest, accrued and deferred interest for the 8-week period. But the application is very straightforward, that on the line where you list your loan amount, it just says enter the principal amount of the loan. So that seems very contradictory to what they have said all along. And one thing I do feel that Treasury has tried to do is come back and say that was not our intent. So everything from the beginning has said we're going to give you for your forgivable amount will be the principal and the interest up to that point. And the application does not read that way. And then, as we just mentioned, clarification of how you calculate the 25% reduction on hourly people. Is it truly just look at their rate and say they were making $10 before this happened an hour, they're still making $10, I'm out, no further calculation needed? Or do you have to take that $10 times some average of hours worked in the 2 different periods to figure out if there's a reduction? The rate makes a lot of sense, because I do think the intent is not to punish people twice, because, and really 3 times, is you had the ability to be punished 3 times on a reduction. If you don't spend the money, it's not going to get forgiven. So first of all, like we've mentioned, payroll costs spent is the first and foremost thing you've got to do. And there's really no relief for that. The second was, if your FTEs have dropped, we're going to give you a ratio to reduce your forgiveness amount. Well, they've given us a safe harbor on that and basically said, if your number of FTEs at June 30th is back up where it needs to be, we'll throw that out. And then the third one being, if you paid somebody in an annualized format, now at least they have given us that ability to make the 8 versus 13-week period equal. If you've reduced people's wages by 25%, you're going to get another reduction. So they've given us a safe harbor on those last 2 that I really feel like, I'm hoping 85% of clients will be able to benefit from that if we can get the economy going in the next month and a half. So I'm hoping those 2, we're not going to see a lot of reduction, if any, for people. But again, the kicker really comes back to, did you spend the money during the 8-week period? Because if you did not spend it on payroll cost, as the application shows, that is the ratio that's what's going to limit how much is forgiven. So I really think the big focus has to be on spending. I'm hoping, if you feel like you can get your FTEs back up by June 30th to where you were before this started, I think we can really get everybody past those 2 hurdles. It's the spending during the 8-week that's going to be the tough one, in my opinion. Matt, anything else there? He may have muted himself.
Yep, I was accidentally talking to myself, so I apologize for that. But no, I do think those are great points. And like I said, that clarification is going to be really key. because I do think it is very advantageous for our clients, but we're hoping and praying that they don't come along and say, well, that was not our intent. But based on what we've seen and how they've released their guidance, they continue to clarify the original intent, and it seems to be more and more of relaxing kind of these requirements that we who are reading the actual interpretations are like reading it and saying, okay, well, this doesn't quite make sense. What's the definition for these items? And so those definitions will be key going forward.
And I know we'll dive into some questions here in the last, roughly 15 minutes we have. But I think, yeah, the next slide we'll just wanted to mention, and I think we've already said it today, we're diligently working on trying to simplify the spreadsheet to meet the application. I don't know if simplify is a good word. Matt might smack me around for saying that, but I think if you can meet those two safe harbors, the record keeping and the spreadsheet's going to be pretty simplified. So I think those are two big picture items to really think about. If we have to dig down into those calculations further, it's going to get complicated. It's going to be more complicated probably than we were even presenting to you in previous webinars. But I really truly feel that the amount of people that are going to drop down to those calculations is going to be much more limited, and it just may have to be more of a one-on-one conversation to work through that if you have it. But if you're going to be back up by June 30th and you haven't reduced anybody's salary or pay, I think you're going to find the process much easier than we originally thought. So I think that part is that's very helpful, and I'm really glad to see that coming out of the application process. One question I'll go ahead and that I saw pop up that I will make sure we update our slides to be clear, but rent. I know somebody asked, what about rent on, you think real property, the application does actually say rent on real property or personal property. So it does appear that leases on equipment and vehicles, medical equipment would count. So just kind of as a side note, I don't think we really pointed that out on our screen. So we'll update that. But it does say real property or personal property. So I do believe those lease and rent payments will definitely be able to be deducted as a non-payroll cost.
So I do see lots of questions here. And so like I said, I'll definitely try to get to all these. And I know we will definitely for sure answer these. We will save this chat and get a FAQ put together and put that on our website to make sure that every question in here gets answered. So do bear with us as we go through. Keep sending them if you have them, because we will get to them and make sure that gets put on our website. But just kind of looking through here, I see one question back at the beginning that was talked about the disbursement date, not the loan date, and that is correct. It is now the first disbursement date is when the 8 weeks starts. They have clarified that. It used to be in the original language the loan origination date, and they have come along and said, well, that could have been 2 different time periods, 2 different days, and so they've actually usually gone with the later, which is the disbursement date, and so it is the loan disbursement date.
And I think Matt, the chance that those are different are probably going to be pretty limited. I've talked to a couple clients who, for lack of better words, maybe the bank has to close the loan within 10 days. So possibly paperwork got dated that 10th day, and maybe they didn't get it signed and the money till the 12th day. So I know that situation did occur, but I do feel like most of those would all be the same.
Lisa, question on here. So we pay on the 7th and the 22nd of each month. How do we adjust? I think that's going back to that alternative period.
Well, I think if you are the 7th and 22nd, you would actually be considered bi-monthly, if that is truly your pay period, not bi-weekly. So I honestly, Matt, I don't think they have the ability to adjust their alternative period.
That's correct. I would agree.
Now you can still do the paid or incurred, so you'll be able to accrue, some earnings after the date to meet your 8-week period, but you cannot technically choose the 8-week alternate period.
Looking through here, it's a question here is how far in advance can you prepay rent?
I really think, I mean, there's no clarification on this, but I really think the most anybody's going to be able to get in here is probably 3 months. And that's going to be if you held off and didn't pay your rent until you got your PPP money, and then you're going to get the rent that covers the 2 next 8-week periods. I think you'd be hard pressed to go over 3 months of rent. It's not in black and white anywhere, but that would be my opinion on the most you could probably go.
Great point. Lisa, question on here. What about combat pay or stay incentive pay?
I've seen both of those used. We've advised clients to use. I've seen sign-on bonuses bringing people back as a method. So yeah, all those things. The big thing to remember is you can only use payroll cost on any one person of $15,384, which is $100,000 divided by 52 weeks, annualized to the 8-week period. So as long as you're not taking them over that amount, you shouldn't have any problems with that. So we have seen lots of construction companies given some hazard bonuses for having to work out in public places. So we've had some retail businesses that have done that, have upped pay, hourly rates or bonuses. We've seen it done both ways. We've seen nothing to say that that's not acceptable. I think it's very acceptable, on every webinar or article I've read uses that as a method of spending your money.
Question here, and I believe I'll mention this and we'll try and walk through it here, but if you use paid for payroll, do you have to use paid on non-payroll also, or can you choose to use incurred on non-payroll?
I think you can choose either one. I think the or is there for both sides, and you don't have to be consistent. It's just basically, did you pay it during the 8-week periods or incur it? So you're gonna try to use those in the way that you can get the most expense. And what I would say is you kind of need to look at it. Don't really sweat that if you don't need, see where your payroll costs are going to be. Remember that has to be 75% in that calculation, but you may not need all of the non-payroll costs to get you to the total forgivable amount. So just, you do not have to list things unless you want to, right? Because you are, from a documentation standpoint, you're going to have to give the bank payroll ledgers again to support your payroll and your FTEs. And then you're also going to have to give them canceled checks or bills to substantiate the non-payroll costs. So, look at your calculation and see how much money you need to get the full benefit of the forgiveness. And don't put anything more in there than you need, because it's just going to create more work for you.
Great point. I'll kind of answer this one. I'm assuming this question is geared toward the FTE calculation. Do you include overtime hours? And so if you're using the simplified method, you would just kind of look at everyone over 40, and they would basically just get a numerically 1 next to their name and be considered one full-time equivalent. And then you can obviously, if they're any under 40, you would use the 0.5. And so if you're using that method, you don't have to necessarily worry about overtime hours. They would be excluded from that calculation. Is that a fair statement, Lisa?
Yes, agreed.
Okay. I was just scrolling down here, see if we can catch some of the ones that have come out here. So transportation costs, we buy fuel for tanks at our company. So if that is the case, can we include the invoices from our fuel provider to include as well as any receipts for fuel?
I would say that's probably a little bit of a gray area, but if that fuel is being used to fuel equipment and trucks that you're using, the way I read it now, Matt, you agree, and I think everybody else is, that we've seen on that, I don't know how you can't count that, really. It says fuel. So, and I guess with the loosening of items saying that you can deduct mortgage on personal property and you can deduct rent on personal property, I have no reason to believe that isn't what they're trying to catch there as well.
Lisa, I know we've talked about this one. I'll just kind of state it and maybe we can make a statement, but this question is, our retirement plan is a 401k profit sharing that is paid at the end of the year. So can we take an estimated accrual?
I think you can. I think, well, I don't know if you can estimate an accrual because it says you have to pay it by the next billing date, which might be hard to, but I think if you paid it, you definitely could count it. So I know that's the question I've had from a lot of clients that haven't. Sometimes they wait till September 15th to do their match on retirement plans, but they may go ahead and do it now if they can count that cost, which I think they definitely can with the paid or incurred rule coming out. Or profit sharing, I know you kind of put in as the year goes. If you wanted to go ahead and do something, I think you could. But I don't know if the accrual, because I think the verbiage says the accrual has to be paid by the next billing period. And I don't know what they would define that billing period on that 401k. Matt, I don't know if you have anything different.
Same way. I think if you're going ahead and paying it now and it was in the 8-week cover period, then yes, I think it would count. I would agree if you're accruing for something in the future, that one's probably not going to be considered as part, but we have had some. Go ahead.
I would just say, again, see if that's what you need to get everything forgiven. If you don't need that to get you to your total amount, then I would throw it out and not play in that gray area if it's not clear by the time you file your application for forgiveness. Just kind of see where everything else falls out. And if you feel comfortable putting it on there, fine. But I just would, those really gray areas that there's no good guidance on, I'd kind of keep them over here in a little column and only pull from those if they're really needed.
Question on here, are owner employees included or excluded from FTE calculation?
That's a little bit interesting. I think they're included, but in the application, one thing they have done is they have pulled out an area for owners to be calculated separately. And so we really don't have a whole lot of guidance on what the intent of that was to pull the owners out separately. I've read a couple things where they may say that they're thinking that's to throw out health insurance for an owner, but there's nothing in the application that says that. I think those are just interpretations, but they have pulled out on that worksheet, Matt, owners as a separate item.
They have. I have seen that, and so it also references, it says this amount may not be included in your PPP Schedule A worksheet, table 1 or 2. And so if, say the example is compensation to owners over $100,000, they would be in that table 2, but limited to that $100,000 cap for compensation. So the wording is definitely kind of complicated to read there, and so hopefully we can get some definite guidance on what their intent was to separate that out for.
Yeah, and I think, again, if you're counting them in the comparison period and counting them in this period, no harm, no foul. And if you don't count them in both, it shouldn't really change anything. The only thing that would change is if you have owners on payroll now or owners on payroll then that aren't on there now, that would really change your calculation. But really, if you're comparing apples to apples, it shouldn't skew anything very much, I don't think.
Well, Lisa, I know we're coming up on 11 o'clock here. We'll try to stick to that hour time frame. Is there kind of any closing remarks that you have?
Stay tuned. This is what we have right now, which is better than what we had last week before Friday. So we actually have the application. We can look at it, but now all the questions begin. They can, and I don't envy their position because they put something out and then accountants and businesses ask 1,000 more questions of needing guidance, but it is what it is. And we will digest everything as soon as we can and share what we learn as it changes. So just stay tuned. And if you have questions, feel free to call or email Matt or I. And, we've had a very busy webinar today with a bunch of participants. So if we don't get back to you today, just know we will get back to you as soon as possible and help you in any way we can. So Matt, anything from your end?
No, I still see some questions coming in here, so feel free. We're going to be on here. We'll actually close the Zoom call here, but if you want to put some questions in the chat, like I said, those will be answered and put on our website. So if you have a lingering question that maybe didn't get answered, go ahead, feel free to put that in there, and we'll do our best to get that up as soon as possible.
And watch for the spreadsheet that will be coming later this week as well, which will probably cue more questions. But thank you all for attending today. Hopefully it was helpful, and appreciate all your attention. Thank you.